I believe that we could test 2,600 to 2,650 by the end of this year, first quarter of next. But if history moves at the same pace as it has been, that could be much sooner. But right now, according to my particular count, we are in a third wave. Typically, for those unfamiliar with Elliott wave, it looks at a market as being bullish or bearish and gives it a bull or bear count. So we are currently in a bull count.
Gold prices continued their remarkable price advance following the Federal Reserve's latest FOMC meeting, signaling a potential shift in the central bank's monetary policy. The precious metals December futures contract opened at $2,455.60 and closed at $2,493.40. Marking a substantial daily gain of approximately $38. This surge brought gold within striking distance of the psychologically significant $2,500 per ounce mark, after trading to an intraday high of $2,496.60. Gary Wagner, a technical market analyst with 25 years of experience, provides comprehensive technical analysis and has revised his forecast. Initially predicting $2,500 by the end of last year in the 2024 outlook, he now suggests that gold could test $2,600 to $2,650 by the end of this year or the first quarter of next year. He is a frequent contributor to Stocks and Commodities Magazine and has also written for Futures Magazine and Barron. Gold was in a sideways consolidation period from 2011 to 2024, and this year, in March 2024, the price finally made a strong breakout bullish candle on the monthly chart that changed everything. Looking at history, gold made its first record in December at around $2,480, the second at $2,504, and the most recent one on July 17th at $2,510. From a technical perspective on the monthly chart, we can see that the price of gold is inside this ascending parallel channel since the year 2000. Elliott wave theory is one of the most accepted and widely used forms of technical analysis, using since the 1950s, allows for some interpretation. Wagner mentioned that, according to Elliott wave theory, gold is starting an impulse wave, which is typically the strongest wave. Ready to uncover more insights? Remember to subscribe and turn on notifications always to get our latest content.
We have been flirting with new record highs, since the beginning of April. And when you look at the chart, what it tells you is that as a market technician, we are very limited on tools that we can use to do forward predictions or forecasting, because guess what? We have no historical data to look to see how the market reacted. In the case of where we're at now, we've got a couple of peaks. This is not the third all-time record high, but it could inevitably go to the all-time record high. So we're sitting at about 2490, and the call that I'm looking at, and it's a revised call from 2,500 that I did at the end of last year in my Outlook 2024, was just 2,500. But we went there, got to that price point. I believe that we could test 2,600 to 2,650 by the end of this year, first quarter of next. But if history moves at the same pace as it has been, that could be much sooner. But I'm not looking for these numbers to come a week from now or at the end of the month or anything like that. That's my long-term forecast. As for right now, we're approaching the record highs and record closing prices that occurred. We've had 3 of them since April. The first one, and this is going to reference December prices, occurred at around 2,480. The second all-time record close was the most recent one, which occurred on July 17th, was 2,510. In terms of where we are, there's a couple of things we can use. We can reference some lagging indicators like moving averages, so that the fact is it is trading above the 50-day. So we can say with a degree of certainty that on a short-term bias, gold is in a very bullish mode right now, unquestionably. It's above the 50, 100, 200, and that's what we use. But in terms of predicting price points, The only way that I'm familiar that we can forward forecast a commodity that's at a record level is to either use what's called a Fibonacci extension and use that in conjunction, well, I do, with Elliott Wave, because Elliott Wave is a model that's been around since the 50s. There is room for interpretation, which is why some people love it and some people do not. But right now, according to my particular count, we are in a third wave. Typically, for those unfamiliar with Elliott Wave, it looks at a market as being bullish or bearish and gives it a bull or bear count. So we are currently in a bull count.
Central banks have been major gold purchasers over the past 2 years, so the market has become worried about whether they will stop buying amid high prices. They bought 1,037 tons last year, the second most after a record high in 2022, and double the annual average of around 500 tons over the past decade. 20 of the 70 central banks that responded to a WGC survey indicated that they intend to hike their holdings in the next 12 months, according to its 2024 Central Bank Gold Reserve Survey report published last month. Wagner asserts that as long as central banks continue to buy gold, there will be price support at definitive levels. Wagner makes it essential for all investors to allocate a portion of their portfolio into precious metals. Following the blueprint of central banks, who are unlikely to make mistakes in this area, is a sound strategy. Now let's redirect our attention to a video.
All investors need to allocate a percentage of their portfolio into precious metals. Absolutely. And what percentage that is going to be based on their A, risk parameters, B, their age, and most importantly, their goals. I think that because gold has reacted in a much more sensitive way to geopolitical skirmishes, uncertainty, as well as reacting to the Federal Reserve, what they're doing with interest rates, I'm impressed with is the fact that central banks are buying gold at record amounts. And that tells you something, because if they're allocating their fiat currency, their currency, in the case of the Fed, our dollars, into gold. China's doing it. India's doing it. Many countries are doing it at a pace that they never have. That could be another reason to explain why silver's underperformed. Typically, central banks don't buy silver as an asset to add to their holdings. But central banks have been strong buyers. As long as that continues, there is going to be price support at definitive levels. And I believe that that's going to keep going for one simple reason. And that is, I don't know of any country, I'm sure there might be a couple that are close, but that are running at a neutral budget, meaning they're spending equivalent to their GDP. In other words, they're not adding to their fiscal deficit and getting deeper in debt. As long as government's doing that, the currency that country uses really can't gain value when they print more of it. And so that's overall one of the most predominant factors that all investors allocate a portion of their portfolio into the precious metals. As long as the central banks are buying, there's no reason why you shouldn't follow that blueprint. They're not going to make mistakes in that way too often. And the fact that they're buying at a record pace is saying something. And if you look deeply into it, it's not a pretty picture in terms of the economics of the what country's central bank is doing this. There's a reason that they are moving currency and converting it to gold. There's a reason that they're doing that. And it's the same reason that the public should be doing the same thing, taking a percentage of their portfolio and moving it into a long-term allocation plan of gold or silver, gold and silver, or just gold.
Both gold and silver prices recorded a hike on the multi-commodity exchange on Wednesday, July 31st, 2024. As the market anticipates potential rate cuts, gold's performance in the coming months will likely be closely tied to further developments in the Fed's monetary policy and broader economic indicators. Bloomberg noted that history supports their bullish stance on the precious metal, as the dollar slid more than 10% during Trump's term in office, while the spot price of gold rallied over 50%. How might potential rate cuts by the Fed affect the price of gold? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.